Hi, I'm Jim Costello. I'm with MSCI. I'm part of the real assets team, which is real estate, infrastructure, and other real investments. I'm an economist. I take a look at trends in our data and I tell stories about those trends to help clients understand what's happening in the market and how to think about how they should be deploying capital in the future. Views on market risk. In part it depends on what's happening in the cycle. Every cycle has elements that rhyme, but the performance is different through each one because there's different drivers both on the upside and the downside of the market. So risk in kind of a classic sense in modern portfolio theory, go all the way back to Markov, and people think about it as mean variance around returns. That doesn't work so well in commercial real estate because the way people think about risk investing at the asset level, it's more situational. They're worried about issues of things around the property that are going wrong. Will the tenants stick around? Will construction of new assets nearby undermine my performance? Will the economic growth in the city continue at a pace that supports the underwriting I've undertaken? So in every cycle, I look at a variety of those issues, but they have different levels of importance throughout my career in all the different ups and downs we've seen. In the early days of my career, I was a young guy working at a group in Boston called Torto Wheaton Research. Back then, when I started, we were part of a group called CB Commercial that later evolved into the CBRE we know today. And the market was a lot different in a number of ways. Number one, information was harder to come by. It was still a very opaque market. Compared to the public markets, it's still an opaque asset class. But back then, people were debating things like what is market vacancy, because there were so many different folks trying to capture that. The information space has improved over the years. And with that, people started to focus on other elements of understanding where the market was. Throughout all of it, you had to look at different issues in the economy and different types of economic indicators to make sense of what was happening in that particular cycle. We had the oversupply of the 1990s. We had the surge in demand during the tech boom and the fall that happened. The increases in investment as the CMBS market got roiling. Every one of those had some characteristics that rhymed, but there were different drivers from each, and you had to think about different things to be analyzing across each part of the cycle. Over the whole time, the main thing that's differed is that you've gone from an analysis that was a lot more focused on just trying to understand the economic drivers of each city to much more of a focus on what's happening in the broader financial markets. The turning points in the market, for every cycle, then I've been looking at different indicators. In the aftermath of the S&L crisis, as I was coming into the industry, that's where vacancy was vitally important and trying to figure out when we would start absorbing all the excess space that was built during the development boom of the late 80s and early 90s. And there was a lot of focus then on sort of pre-leasing activity, just how quickly assets that were still in the pipeline were filling up. Into the boom into 2001 during the tech boom, a lot of the focus then was, what are the signs on rent? How much further can we achieve higher and higher rents? And at the time, I remember looking at the magical $100 rent counts, how many leases were coming in at $100 a square foot in San Francisco, and watching that drop as the market started to show troubles. The current cycle, the thing I've been looking at more than anything, and when I say cycle, I mean really the last few weeks with the tariff turmoil that's originated out of DC. The thing that's had most of my attention is the corporate bond market, because the way I think about real estate, it's just the box where the economy lives. And you can drive the value of it by looking at the income streams coming from the tenants who occupy that space. But those tenants, they're corporations. And they owe something to you on the rent. It's a sort of a debt. But the public markets on their corporate debt is so much larger than the real estate market. And it's priced daily. So if you have a building, and let's say that Microsoft is a tenant, the corporate bond market is saying that maybe with the uncertainty, Microsoft's debt, and I'm not picking on Microsoft, I'm just picking a random company. I haven't looked at Microsoft's debt recently, but this is the process I'm using just with the broad indexes. But if a company's corporate debt is suddenly riskier because the public markets are worried about a recession, then shouldn't the income streams from that corporation as a tenant be ascribed as more risky? And this is an issue that I've been focusing on to think about how should this turmoil filter over to commercial property valuation. And it's an issue that I think we really need to focus on because you have a challenge in North America where appraisals take a long time to reflect the underlying reality of what's going on in market pricing. I mean, this is not a new thing. After the financial crisis, London and New York, two very similar markets, very similar economic drivers, they experienced a shock of the GFC equally. Cap rates in London rose a full year before they did in New York, simply because of different appraisal standards, where New York had to be following the USPAP in the United States, which is very backward-looking, looking at sales comps and treating these things as objects as opposed to investments, as opposed to London, where the Red Book from Rick's allows you to think a lot more about these things as investments and range of investment, potential investments. And so I've been using that kind of process myself to think about where we're going, because I fear, just given the things that appraisers have to do given the regulations in North America, they'll be a little bit more delayed again as they have been in other economic shocks. The pandemic and issues around valuation. The challenge with the pandemic is the way it disrupted price trends over previous cycles. If you look at the history of prices, looking at data from my company, some survey data that was around back in the day, price cycles were usually pretty slow moving. The most of the shock to pricing came from the slow, long-run trend in construction cycles. Construction ramped up, vacancy would rise with a little excess space, rents would decrease, and it was a slow process that would work out over a number of quarters. So you can see these nice long sine wave patterns of price trends. 2020 hit, and it's like taking a rubber band and stretching it really far back and letting go. And it's just been oscillating back and forth since. The challenge with valuation there is sometimes we've seen situations where people value something at the zig, thinking that the zig, the top of the cycle and the near-term movements is the permanent movement, as opposed not understanding it's going to zag back down soon. And so, like when the 10-year Treasury went down to less than 1%, you had a number of investors jumping in with abandon because they had a need for yield. Real estate was throwing off yield, but they paid an incredible price for it. Many of those folks are struggling today. A region in particular that suffers from that, this is southeast of the United States. A lot of syndicators got ahead of their skis on the multifamily market. And that kind of volatility has cost people because they've been misreading these slow moves in the very near term as kind of a permanent direction, as opposed to an ongoing shock that's been impacting the market since 2020.